Welcome everybody to another session for our new note for August. And just to say thank you for joining us this evening, and for those that will watch the recording later. If you do have any questions, you'll see I've put in the chat. If you do have any questions, please ask as we go along. And also, if you are new to structured notes and would like to attend a session to understand how they work and why they can do what they do, just again, pop it in the chat, or you can send Kim an email at support@Cashbox.Global, and then we will book you into a session where you can run through how, to understand the structured notes. Tonight, we're going to just be going through the product. So if you don't understand or there's something that's missing, we're happy to set up that understanding session. So just to do some housekeeping, as we always have to do. For those who don't know, and for those who do, just to remind you, Cashbox.Global is a financial services organization registered with the FSC in Mauritius, and we provide international investors with access to secured investment contracts offered by Europe's strongest banks. We design and provide access to these structured contracts, which are called structured notes, and Cashbox.Global does not offer any investment advice, nor do we make any recommendation regarding any investments. All information should be read and understood by the investor. Investors should seek suitable financial advice before investing to ascertain the full risks and terms associated with the investment. Our presentation tonight covers product information for education purposes only, and while Cashbox.Global structured notes have a strong track record, past performance is no indicator of future performance. And with that, I'm going to hand over to Andrew.
Right, thanks very much. Yeah, can you believe it? In the middle of August, nearly. And if we look at the top left-hand corner, this particular note strikes its values on the 26th or 20th of August. So it's all rapidly coming at us quite quickly. This is a growth note. So I'm just going to deal with the slide quickly, then we're going to talk around it. It's a growth note. In other words, it's designed to accumulate the coupons, not pay them out. We're delighted, and I'm delighted Graham McCallion is on the call. You heard him earlier. Graham is our resident magician and wizard in the Isle of Man at IDAD, which is our structuring counterparty. And I'm not going to throw Graham under the bus because he's a seasoned professional.
No,
but I'm going to invite him to have a few comments from time to time and take the hard questions. But this is what's known as a triple index classic Autocall. Let's not get too wound up in the garbage, the verbiage or the garbage. It'll come out in terms of the presentation. I think what's important is the headline coupon rates there in three currencies, which Morgan Stanley has underwritten. We'll deal a little bit with Morgans themselves. We're delighted to have them on board as the underwriter, as the issuing bank. In other words, Morgan Stanley has underwritten, have contractually obligated themselves to the terms and conditions and specifically to those coupon returns in the note. Morgan Stanley is a massive bank and quite picky in terms of how they approach underwriting notes. So we were absolutely delighted when in fact they produced a note on very similar terms in July. It wound itself up very quickly, was very, very popular, and Morgan's decided it was a great opportunity to pretty much fill and go again on the same basis. Slightly altered coupon rates, because as one would appreciate, things are changing all the time, specifically interest rates that have been moving upwards. But a superb structured product, a great issuer, tier one, A-grade investment bank. And the indices, which it refers to a triple index, we've got three world indices that have been included into the underlying investment story. So that's pretty much in a nutshell what the structured note is all about. So why indices again? I mentioned that we have launched this before. It was very popular. And I think one needs to take a step backwards. Many of you may have participated in previous webinars. We've been very fortunate to be able to, with IDAD, to produce a product and bring it to market almost one a month since the beginning of this year. And that, I think, in context, is quite an achievement given the headwinds of change and the headwinds of challenges that we've had to face since the beginning of this year. I'm not going to dwell too much on the past. Safe to say that the world, the global world, is in the throes of change. Many of the usual suspects, including inflation, interest rates, supply chain issues, equity crushed valuations, and volatility, they're all in the mix. But this again, this combination has led us to using an underlying reference basket of indices rather than using individual equities, which has been very much the common sort of solution in the last 2 to 3 years that we've produced. In fact, the July issue was our first indices-based note, as opposed to just producing a basket with underlying individual stocks. And I think to take a step forward, I'm always trying to be positive, take a step forward, and then take a step backwards and look at things. That's easy. Minimizing risk is really the name of the game at the moment. And I think in the addition to the usual protection that we include in a Cashbox.Global structured note, we have further reduced risk by spreading the concentration across the constituents of all those indices, 3 indices, again, rather than limiting it to a spread of 3 or 4 stocks. We've spoken about Morgan Stanley. They were very comfortable to produce another note. There needs to be a win-win for the bank as well as for ourselves. So it gives a great deal of comfort that there's the environment, the environmental factors are there to include indices in this type of note. So I think just before we move on, I think what the important points to remember when considering a structured note is, I've mentioned it, the strength of a bank needs to be in our space. It has to be an A-rated bank. It has to be a tier 1 bank, not just a household name. It has to pass the tests of the credit rating agencies, the Moody's, Fitch's, S&P's. It's not to say that they can get it wrong, but certainly that type of analytical, quantitative and qualitative testing is one of the biggest credit risks that we need to get over. And we are very comfortable with this type of bank that has issued it. I think those returns that you are seeing that are quoted as headline coupon earnings, they are net of costs. Often this comes up at the end of a presentation. I like to get it out in the beginning. So what you see is what you get. No hidden costs, nothing opaque. It's as per the terms and conditions of this contract. So every note is a contract. There's T's and C's. They cannot be varied. They cannot be altered. The license of that bank in the jurisdiction in which they are domiciled regulates that.
Andrew,
right,
sorry to jump in there, Andrew.
Absolutely.
Because I think we'll do that if that's okay with the way we go forward. But just to reiterate, because I know Andrew covers everything so well, but I know we get bombarded with figures, but in the context of Morgan Stanley as a bank and as an investment bank, Andrew's absolutely right. The tier 1 capital ratio of Morgan Stanley is nearly 20%. So that's the Basel 3 tier 1 capital ratio regulatory requirement, which is huge. It's a heck of a ratio, and that is on the basis of nearly 82, in fact, just over $82 billion capitalization. And to just give you the context of that relates to, and I'm using Barclays because I'm a Brit, but Barclays is about 19 billion in comparison. So, and again, size is not everything, but it does play a part. And, because we've seen problems in the past, obviously, with the credit crunch and Lehman Brothers, but nevertheless, the size of the business is gargantuan, coupled with the fact that the Capital 1 tier ratio, which came in as a very strict regulatory requirement post credit crunch scenario, at 20% is phenomenal. So again, that risk element that Andrew refers to, and there's no question about it. The 2 key points really are counterparty, i.e. the investment bank producing the note, and the basket, which is effectively the engine of the note, which drives the returns fundamentally. And to have those 2 elements with the indices that we've used and the investment bank we've used, it's a relatively rare opportunity to execute a note that delivers the return across those 3 key currencies within the global framework. anywhere between just over 14% in dollars to 9% in euros, is quite phenomenal. So just to really sort of reinforce and underline what Andrew's saying there.
Thanks, Graham. Yeah, it's very useful to have that. I mean, why indices? This is one of the indices that we have used. We're using 3 disparate and unconnected indices. That said, most of the companies that are represented across these 3 indices have revenue streams from all over the world. So you often find that they have representative businesses in different geographic areas. So Euro stocks is obviously the European scenario. Without going ahead, I'll just mention the others. The other is the Japanese market, the Nikkei 225. So that covers Japan essentially. And then we have the NASDAQ, which is US based, but they are global companies registered on the tech-heavy, technology-heavy, digitalized-heavy US bourse in the United States. Each of these slides that you're going to see has some technical stuff there. But let me just reiterate, why certainly a bank the size of Morgan Stanley, and why does it make sense to go with indices yet again? Well, I'll tell you why. Let's begin with the bad news. The bad news is that we've just experienced, probably in the first 6-7 months of this year, the worst half of any trading year in probably the last 50 years. It's come at the investing public from every single direction, and it's been very, very tough. At the moment, as of last night, some of the indices slipped back out of a bear market or a corrective market, but it's volatile. It's up and down, up and down. The fact of the matter is we've seen massive valuation crushings, and we've seen a lot of value in the markets being written off. It runs into the trillions of dollars if one has to capitalize and pull the trigger and say, right, what have we actually lost around the globe? People even talking about recession, okay? And just bear in mind these thoughts that I'm sharing with you against what I'm then going to do in terms of taking you through each of these indices. So we're in a tough place. It's a pretty dark place. Things could obviously get worse if the various geopolitical stresses, mushroom even further. But typically, as I mentioned, the bogeyman of inflation, interest rates, supply chain blockages, they're still there. It's come very hard this year, especially interest rates. And we are hoping that 2023, certainly, I think the second half of this year is going to have its challenges. There's no straight line recovery. But I think as into 2023, maybe we'll see inflation being tamped down and interest rates being relaxed a little bit, or at least reaching a par. So what has happened this year? A lot of people have lost a lot of money. But a lot of people have also hedged their wealth into structured notes, which have a contract of protection as well. That's important. Now, instead of choosing 3 or 4 constituent, well-known, household name companies, we've chosen 3 large indices. So straight away, we have spread, in this instance, in Euroland, we spread it across 50 of the largest capitalized companies that are registered on the Euro stocks. These are all household name type of companies. So typically, they'll represent different sectors. It's not just one sector heavy. The NASDAQ is different because that is sector heavy in terms of technology and in terms of digital companies and e-commerce, etc. The Euro stocks and the Nikkei are a little different, and you'll see it in there's a slide that comes up that demonstrates this very, very clearly. This represents sectors right across Euroland. It could be manufacturing, it could be motor vehicles, it could be luxury goods, it could be pharmaceuticals. The names are all synonymous with well-managed companies. And I think this is what is very important. One of the reasons that a company like Morgan's would look at inclusive, having Euro stocks or Nikkei or NASDAQ inclusively in a basket, is that it then is getting access to all those underlying companies which have superior earnings. I'm a fundamentalist in terms of analysis. So when I look at a business, I analyze it on a fundamental basis of how well is it doing and why is it doing as badly or as well as it is. So I do a price earnings comparison. I will look at what their earnings is, what their revenue streams are, what their profit margin is, how much debt they are carrying. And these companies literally are carrying the best type of quality that fit into those particular indices. So you won't find an aberrant company that's in there that's happened to be included. You have to get into this particular index. So this is, as Graham says, he calls himself a Brit. If anybody's familiar with English football, this is the Premier League. This is the top notch of those type of companies that get included into that particular space. As I mentioned, most of the companies that you will see, most of the companies that are represented in these particular stocks have worldwide global earning streams. So they're not dependent on Euroland only, or in America or Japan.
Yeah, I think Andrew, sorry, Andrew, just to add to that. I mean, if we, interestingly enough, if we look at Euro Stoxx 50, and I'm certainly by no means going to analyze all of the 50 that are within the index, but when you think about it, Morgan Stanley's competitors, BBVA, BNP Paribas, these guys are in there. These stocks are in there. You've got BMW. You've got gargantuan corporates, as Andrew mentioned. The size of these businesses, they're monoliths in their own sectors. So, to look at an index which gives us comfort, which gives us that sense of security against hard times, which unquestionably we are going to see. I think that, we have the ability to be able to.
Seem to have lost Graham.
Jill, you're on mute.
He'll probably pop back on. Do you want to carry on?
Yeah, I'll carry on.
Move on.
I think what Graham was saying is that these are all household names. If I look at the NASDAQ, it's technology heavy, it's digital heavy, it's all those electronic companies that we've become so reliant on, which COVID and the lockdowns that came thereafter pretty much thrust our future into the now. So what was futuristic became part of our everyday DNA. And again, these 100 companies, they're totally diverse across the digital space. So you might have semiconductor companies, microchip companies, social media companies, social interacting companies, cybersecurity. They are all in there. So this is probably the fastest moving of the particular indices. You'll see it in the slide that's coming up after the Nikkei slide, is that this has probably been included by Morgan Stanley for the spices, I call it, in terms of squeezing and tweaking and getting the best possible payoffs that the T's and C's allow.
Sorry, guys. Sorry, guys. We've got our own load shedding. Sorry about that.
Pay your bill.
I do apologize.
So that gives a flair. I was just saying, Graham, this is probably where a little bit of the spice, a little bit of the fizz comes in terms of, yes, it is a little bit volatile. These were the guys, the companies that you'll see in here pretty much led I always call it the rubber band recovery that started in March 2020. And some of them were pandemic darlings, and they haven't done that well subsequently. They're having to, redefine their business, reorganize. But many of them are really part and parcel of our DNA. They are with us here to stay, and probably becoming even more so entrenched in our, sort of daily lives. And then moving on to the last one, the Nikkei. Again, it's if we can just move to the next slide, please. Right. Sorry, I beg your pardon. Back to the Nikkei. I was looking at a different screen. Sorry. Yeah. So this is also constitutes these large capitalized companies found in Japan. Typically, one would think this would be motor vehicle sector heavy, the Hondas and Toyotas, etc. But you'll find a wide variety of companies in there. Sumitomo Heavy Industries, Kikkoman, the soya manufacturer. They go beyond soya, believe you me. But they really are household names. They're obviously tech heavy in terms of their consumables exports. So your Canons, Sanyos, the computers, their photographic gear. It's a widespread. And again, it's 225 of the sort of household names that you'd find in Japan. Again, across all three indices, these indices are they're being recalibrated regularly So you might not always see, companies participating. They might fall out and a new company fall in. Now, this slide sort of gives credence to the spice, as I call it. The top line, the red line, represents the NASDAQ, which is the tech-heavy American-based index. The middle one being the Nikkei 225, and the green line at the bottom, the Euro stocks. Interestingly, if you look at the bottom two, and this goes back to 2010, so we're looking at a 12-year period, which I think is a fair back test in terms of what has been their performance. And yes, it is stretched over 12 years, so you don't see some of the aberrations in terms of peak to trough type of movements of spikes up and down. But would you agree that those two lines at the bottom pretty much replicate and pretty much mirror each other? To a large degree, they work in tandem. And these I would probably call my sort of more, not safe haven indices, but I would call them my, they're pretty much like super tankers plowing along, not doing anything dramatic. Sure, there was a dip in 2020, as you can all see, and that was a dip that everybody had to go through, but a strong, meaningful, and consistent recovery thereafter. Bearing in mind this is stretched over 12 years. But then the red fizz and froth, as I call it, that's where a lot of the energy in this note comes from. And again, you can see pretty much acting in tandem, albeit at a slightly different raised level, up until 2020. And then obviously that was the recovery. This is where the recovery in terms of certainly the US market came from. And it was absolutely exponential growth. I mean, you can look at that growth, from a level of around about 300% from start, right up to sort of nearly shy of 850%. So it was a massive recovery. And question is asked, are we not buying at a premium now? Shouldn't we wait and bid much lower? I would suggest that since the third quarter of 2021 to the end of 2021, before the 2022 headwinds came in, you started seeing that market trend downwards. And that represents a big correction, certainly into bear territory. If one's in an unhedged portfolio, just sitting with shares in a portfolio, you're looking at a lot of paper losses. But I think from our perspective, in terms of not timing a particular entry-level pricing point, but looking to see where there's value. And I would suggest that, yes, markets may retreat a little bit further. There's going to be volatility, but I think we've got a very decent par discount built into where we were. What's important, and I'll reiterate this again, I think there's a commonality of agreement that the technical world, that was the future, the technological world, finally got it right, that was the future, is very much part of our daily lives. So, electric vehicles and semiconductors and microprocessors and all things digital are not simply going to evaporate. There's a big debate about work from home, work at the office. Are we going into a hybrid mode? This is all going to remain here. So this is a very powerful slide in terms of where we were going. What IDAD do, maybe Graham, you'd like to talk about this, because IDAD also does, and we're very comfortable because there has to be external back testing, some sort of quantitative analysis to say, how would this have performed over a period of time? Graham, I don't know if this is maybe throwing you under the bus.
Yeah, no.
But you should be very proud of these. You should be very proud of these numbers.
No, absolutely. And Andrew, these numbers effectively come out from third-party analytics. So we have various organisations in the UK that look at the notes, look at the back testing. They perform the back testing, and they look at the scenarios, and they actually compute all the statistics that we receive. So as much as we do what we do within our business, there are third-party counterparty eyes that are also analysing this. And just to talk this through effectively, to give everyone comfort as to how we process this and why we believe in what we do, not only ourselves, but obviously working with Cashbox, is to quickly go through this. On the back testing results there, the percentage chance of an auto call occurring, i.e. the note actually auto calling, so the worst performing index being at 100% or more at any observation within its term period, is 97.6%. And obviously, conversely, not auto calling is the difference to the 100%. So to see that chance of the note actually auto calling, so it actually finishing its contractual agreement, paying you the capital back plus the agreed returns in sterling, euro, or dollar, whichever denomination you elected for, is huge comfort. And we all know that back testing does not mean what's going to happen in the future, but it gives us the best chance to understand the nature of the shape that we're producing, and that gives us enormous comfort. And again, when you look at the returns that are achieved, as Jill spots that through in historic GBP, USD, and euro, again, that gives us the indication of the returns that are being negotiated with the investment bank, Morgan Stanley, to give us a very, very clear understanding of what is correct and what isn't correct. Because at any point in time, and again, I don't want to go off on a tangent, organizations can go to an investment bank and say, yes, I'd like to produce a structured note. And if they do not know what they're dealing with, they may be given returns that are substandard to what actually should be achieved. Now, obviously, IDAD has a reputation that we wish to uphold. We have an expertise. We have we have experience in the industry to know what the level should be, and we drive that hard bargain, ultimately for you as the end investor, but also for Cashbox, because Cashbox has a reputation to protect and obviously wants to deliver the best for their investment community. So yeah, I mean, talking through that, it just gives us comfort to understand that the back testing gives us the best chance of analyzing what will and what may happen in the future.
Fantastic. Yeah, and a great set of results there. Right, let's have a look at some of the metrics here, if I can call it that. So these are the terms that would be incorporated in the notes contractual agreement. As I said, the bank would be obligated to perform according to it. Issuing bank we've dealt with, the guarantor is Morgan Stanley. It's got great ratings there, as you can see, the Fitch, Moody's, and S&P. The coupon we touched on, these are worked out semi-annually. So in GBP, you're looking at 5.625, which is 11.25 dollars, 14.25. Now, that's a great headline return in dollars for a relatively, a note that's got a relatively great concentration risk in terms of spreading its risk across these great companies, as opposed to aligning with 4 different companies. And euro, 9%. We've had a couple of questions recently. If I dwell on this just for a second, and Graham, you can perhaps jump in as well. People are saying, why is there such a disparity between 9% euro and dollars at 14.25%, when it was only about a week or two ago that dollars and euros almost got to parity? And they're saying it was almost 1-to-1. So why is there such a big divergence? And the answers I see it, and Graham, please elaborate further. The 1-to-1 business is really a functionality or a result of foreign exchange rates. Okay, that's what the currency crosses do. But what I think what's more important is what has happened in those economic zones in terms of interest rates. So if you look at the rates between what rates are being offered in the United States versus Euroland, they are very, very different. America more recently this year has been very aggressive in raising interest rates to combat inflation. Big interest rate increases of 0.75 at a time.
Yeah, absolutely, Andrew.
Euro is coming off the floor at almost negative interest. So there's that big gap, and that's where it comes from.
That's exactly where it comes from. I mean, sorry to jump in there, but I think it's the best way we can do this. But Andrew, absolutely spot on. I mean, if I can give the audience an example, this is all about, as Andrew mentions, current swap rates. The swap rates on the different currencies, dependent on anticipated long-term interest rates charged in between the international banks. So again, it's quite in depth. It's very bank orientated. But to give you some sort of again relativity to where we sit here, you know, the 10-year swap rate on Rand is 8.74. On GBP, it's 2.1. And so therefore, that immediately tells you, just as an example, that if we had put Rand as a denomination into the equation on this note, that Rand would have sat considerably higher above the sterling return. It's as straightforward as that. And you know, these movements are occurring all the time. I mean, obviously 10-year is not relevant because this is a 5-year contractual term note. But nevertheless, just to give you an example there, Rand sits at 7.85 as a 5-year forward swap rate. Sterling sits at 2.23. Again, I'm throwing loads of numbers, but it's all computed. It's all worked into to drive through the best possibility that we can provide to give this shape the performance that we believe it can give. And yeah, absolutely, Andrew. It's
perfect. Yeah. Okay. Great stuff. Let's look at the term. I think term and Autocall trigger perhaps be looked at together. It has a contractual life of 5 years as an absolute maximum. It can't be extended. So it could last as long as 5 years. However, the Autocall, and for those people who are new on the call who are not quite familiar with Autocall, it's another word for an early maturity event, a trigger that causes the note to actually close early, to finish early. How does that happen? Well, it can happen from 12 months onwards and then semi-annually thereafter. And when it says 100% of initial value, the 3 indices will have a starting price. And at 12 months or semi-annually thereafter, if those 3 indices on an observation date are priced at 100% or above, then the bank exercises its right to close the investment. The full nominal invested that you invested was returned, and obviously the number of semi-annual periods are added together, and this big coupon is returned as almost like a snowball coupon as it gathers momentum. The reference basket we've spoken about. Capital protection is very important. During the course of the investment, the capital is underwritten by Morgan Stanley. It's at the very last observation date. We're calling it to maturity. It's protected to 65%. So in other words, on that last maturity, on that last observation date, so if it ran the whole way to 5 years, if it didn't auto-call or early mature, if any one of those 3 indices was below 65% of its initial starting price, in other words, there'd been a degradation of greater than 35% on any one of them, then capital is at risk to that level, as if you owned the stock, as if you owned the index itself. I would refer you back, maybe we don't have to jump back to it because this is, you can have a look at this, there's a recording of this. But there have been very few 35% drops. And I think that's why we are comfortable, even with the NASDAQ coming off now. We've seen a big degradation. I think it's taken a lot of the pain. A lot of it's now being priced in. So I think we've missed some of that pain. And I think for it to degrade from where it is now, another 35%, you're not talking about a 70% from where it was. So that's quite heavy. So we certainly feel what we call the peak to trough, 35%. We're not really, we've got time as well. We've got five years in which to see the cycle change. Now, if I just deal with that quickly, we are in a cycle. 2022 started with a very destructive cycle in terms of value destruction, pricing, and market valuation destruction. Every cycle ends. It's like the interest rate. It won't go up forever. It will eventually plateau. It'll achieve the results that the central bankers wanted to achieve, and they'll start reducing it again. So everything it's like a cycle of life. And certainly, we certainly believe that another further 35% would be, it's not impossible. Somebody might press a big red button and nuclear holocaust might fall on us, but then pretty much everything is at risk and all bets are off. So we believe that on an index base, because of the wide spread of risk concentration, and the bank is happy to underwrite up to 35%. In stocks, when you have 4 individual stocks, you might get much deeper protection if the bank is willing to do that. And we generally like to, when it's 4 individual stocks, we like to try and push it down as far as we can for the client, down to pretty much 50%. And most of our notes over the last 2.5, 3 years have reflected that. But we're comfortable, I think, as is the bank, to have it at 35%. So it's at that last valuation, and we'll see on the next slide. The availability is that the bank produces an inventory of capacity. In other words, this is not never ending. They would have created a particular amount per currency, and either that gets used up because of the subscription before that date, the 23rd of August, or the 23rd of August arrives, and they might have some capacity over, but that's the date that contractually the bank has to close the business, note down, and we then go into the technicals of starting the actual investment. The minimum investment amount is the same across currencies. It's not currency equivalent. It's 10,000 euros, GBP, or US dollars. The next slide will show you the important dates. Okay, so these are contractual. They don't change. They're built in. Just running across it quickly, they're your target returns at the headline. The observation dates are fixed in stone. So there you can see your first observation date will be the 25th of August, 2023, and the payment date will be the 4th of September. So that's 1 year out. Okay, we're pretty much talking 1 year out, 12 months, and you will pick up obviously that particular coupon if it triggers. It has to trigger for you to collect. It's as simple as that, as I explained to somebody the other day. But there are your observations 1 through to 8, and your 2 final observations are on the 25th of August 2027. So nothing changes there. I find this particularly useful in terms of sticking it into a cash flow analysis, putting it into your diary, your organizer, whatever it's important dates which brings you closer to your actual investment and what's actually happening. Cashbox will always send out a notification from support in terms of what's happening closer to the time, and certainly whether it's an income distribution, which this is not, but certainly we would be in touch with you to say there's actually an observation coming up, and it's absolutely clear that it's actually going to an early order call. Somebody's got some microphone on. Anyway, I think, Jill, if you could take us through the next slide.
Hi there. Okay, sure. Just a quick question. We've got a question on whether it'll be available on the Wealth Migrate platform. They haven't actually come forward to say that they would like to participate in this note at this stage. So at this stage, not, but perhaps you could give them a call and find out from them. The actual note and the fundamentals have been passed over to Rion, who's the Chief Investment Officer. I guess he's mulling it. He does know, obviously, it's time sensitive, and there's the caveat that it will be a first come, first served opportunity. And yeah, he was overseas, so we'll be in contact with him again. But it's certainly not a problem if you pick up the call and give them a call to say, is this available, or will it be available? Okay, so what I'm going to do is I'm just going to run through quickly how a growth note works, just as a bit of a reminder, because it does work differently to the income note. So in order for the growth note to pay out the coupons, it has to auto-call. So for the term up until the first opportunity to auto-call, so in this note, the first opportunity it can auto-call is after 12 months. That's why in the previous slide, it only had an observation after 12 months. But at that point, 2 quarters will have passed. So what happens is they're actually measuring it half yearly, not quarterly, sorry. What will happen is for each half yearly observation, it's going to actually roll up the coupon like a snowball. And for each one that passes until it auto-calls, the snowball gets bigger and bigger. Then as soon as it auto-calls, what will happen is it'll count up all the observation events up until that point. multiply that by the coupon, and that is the amount that will get paid out to the platform together with the investor's capital. So it doesn't pay out an income payment during the term. It only happens on autocall. In the event that the product runs to maturity, which is, in terms of the back testing that you saw, is highly unlikely, because we had a 97% autocall measurement. If it does run to maturity, no coupons get paid out because it has to autocall in order for you to get the coupons. What they're going to do then, they're going to do the capital protection test, and that's what Andrew was talking about just now, where as long as the worst performing index is above 65% of its start value, full capital is returned. So in the event of it maturing and not autocalling, assuming that the worst performer is above the capital protection level, all capital is returned. In the event that it dips below that level, then it'll be as if you had bought into that worst performing index directly, and you will get your capital back on a one-to-one basis. So that's really how the growth note works in comparison to an income note. For those who are interested in finding out more, as I said earlier, about understanding the notes, the difference between the income and the growth notes, then we'll set up that session and invite you through to that. Then just in terms of what's happened since October last year, and you can see protection at work. So since October last year, these are notes that have auto-called. And you can see from the different types of notes that we had Titans, miners, we had a hybrid note, quite a few miners that was really good. We had a number of banks notes. So we've looked at different sectors for opportunities, and it's quite interesting how we've moved over to the indices for now, again, reducing risk. And the average product period since October was only 9 to 12 months before these products auto-called, although they had a 4 or a 5 year term. The reason for this is because we were coming off such a low base after COVID, so they auto-called quickly. With the situation that we're in now, with the world as it is now and the volatility, we are anticipating that auto-calls will take slightly longer. So it's, it could happen in 12 months, but we've got 5 years for it to settle down and get to the point where it does auto-call. And then in terms of the annualized returns over that period was on average 14% in income product and 19% on a growth product. And often you'll find on a growth product, the returns will be higher because the bank's actually not paying out anything until an auto-call. So that's why you'll usually see quite a big difference between an income note and a growth note in terms of returns. Just for those, just as a reminder, for those who aren't aware, we do work in that regulated environment. We are registered and regulated in Mauritius, IDAD in the UK. Financial advisors are regulated within their jurisdiction. In order to access the product, you must have an investment platform, and it's an online platform that holds custody of the product for you. And the funds flow from the investor through to the platform that is yours. We are completely platform agnostic. We don't have anything to do with them. And they invest directly into the product with the investment bank, and the funds flow back the same way. So nobody comes between the investor and their investment. I see there's another question. Does this mean you get no return on the quarterly payments until autocall? Yeah, there's no payments during the term. It is only on autocall, Jan.
Yeah, just to be clear on that, Jill, they're not quarterly, so they're semi-annually.
Yeah, so this particular one is semi-annually, yeah.
Yeah, and absolutely correct. The only time that a payment will be made is if the worst performing index is 100% or more than at strike point, which is the 25th of August. So that's the parameters, and very rigid and absolutely part of the contract.
Yeah, and then just in terms of that back testing that we had a look at, going back 12 years, there was a 97% autocall probability. So that is using the figures going back 12 years. We are now coming off again, pretty low base
Mm.
for it to call again will be even easier.
Mm. Yeah.
Then just in terms of the things that we need to remember, the investor needs to be comfortable with the strength of the bank, which Andrew went through. And also they need to look at the underlying indices and have a view that they're likely not to drop by more than 35% over that 5-year term, because that is where your protection barrier lies, is at 35%. So those are the two fundamental things that you need to look at from a risk perspective. And then if there are any questions, does anybody have any questions? We pretty much at a wrap. You're all very quiet.
Mm-hmm. Looks like we've covered everything, I think, guys. I suppose there's one question that always comes through, and that is, what is the likelihood that this does not run for a 5-year term? Well, that's such an open-ended question, I'm afraid, because as much as we can try and demonstrate with back testing, we don't have a crystal ball. We don't know. I think the features and the parameters and the what to look for has been squarely covered off by Andrew. The risk parameters, the possible returns, the possible, events that may occur within the contract of 5 years is very difficult. IDAD as a business tries to show statistically what has happened with the back testing information. But as I say, we don't have a crystal ball. We don't know. Cashbox has got a very enviable record of the notes that they've produced, which Jill explained there in the period of time that they are auto calling, and the returns that are being generated, the difference between income and capital returns, capital growth returns. So it is really, really impossible to say, but that's investing. As Andrew quite rightly said, that who's going to press that red button? We don't know if it gets pressed, and God forbid it doesn't. But I think what we've tried to do between all of us is that we've tried to produce the best that you could possibly access in the market today, and I believe we've achieved that 100%.
Andrew, there's a question from Willie in Nelspruit, and he said, is the risk of a recession a big threat?
Gosh, again, yeah, it's sort of crystal balling, but Willie, nice to hear from you. Yeah, I would say, in all honesty, recession is not a good thing. It's a little bit like what happened in lockdown. You weren't allowed to go to work, you weren't allowed to do your job, you weren't allowed to create profits either for yourself or your businesses, and clearly that had an impact on revenue flows and revenue streams. High interest rates and value destruction that we've seen during the course of the first 6-7 months of this year have led to a lot of companies coming under a lot of pressure, a lot of sectors. Nobody's really escaped the singes of the fires that have ravaged world economies. So a recession generally is not a good thing. I mean, it's as simple as that. It's like the petrol price going up, or your groceries at your local store going up. It hurts you in your pocket in terms of what disposable income you've got. It creates less of an opportunity to invest when you're using, monies that are necessary to keep the wolf from the door, if you want to call it that. So a recession would affect many, many companies. I think the differentiator of using these type of indices, Willie, is that you are looking at great quality companies who are probably more resilient in the face of a recession than, let's say, perhaps a company that's highly indebted, highly geared. There's a lot of leverage going on, maybe very market specific and timing specific. So again, it's cyclical. Recessions don't last forever. Like peaks, they don't, the peak that we saw coming out of 2020 was not going to last forever. That peak was a bit of a false peak because it was led in an area which was very narrow. It was technology. There were a lot of sectors that got left behind, and they subsequently made huge gains. So the threat of a recession is always there, and recessions normally go hand in hand with high interest rates, with inflation. It's the step past those two. It's sort of stepping off the cliff and into a recession. And once you're in a recession, then it's a cycle again. You need to come out of that cycle. So that is why Morgans look at it from a point of view of taking a 5-year view. That's the longest term scenario contractually that we have, a 5-year view, 60 months. I would hate to be in a recession for 5 years because I think the whole world would change. I think there are enough green shoots and there's enough hope in terms of things coming right. Let's take last night as an example. Investors are very, very fickle, and fund managers are very fickle, and investment banks can be very fickle. But yesterday, the news came out of America that the core inflation rate on consumer price index was actually lower than what everybody had expected. And because of that, the market went absolutely balmy. I mean, markets soared last night. The NASDAQ, the S&P, the Dow Jones, believe you me, they're all 1.5%, 2.5% up. It was absolutely green across the board. The fundamentals were still in place. What that meant was it dragged the NASDAQ out of a so-called bear market. It dragged the S&P out of a so-called technical. But it didn't change the broader brushstrokes of what we are dealing with at the moment. And that is, yes, inflation is still rampant in the UK, all over the world. But the medicine that's being taken now is pretty harsh. And that's why we've seen the knock-on effects in terms of companies getting absolutely annihilated in their share prices. But the medicine is going to work. And I think what's happening is that as interest rates go up, inflation, hopefully, that's the fundamental equator, is that interest rates will tamp down inflation. It'll cool the growth cycle and go down to a more reasonable level, and then the cycle starts again. So my short answer is that I think 5 years is a long enough term for us to move beyond a full-blown recession. I don't think any government wants to see its economy go into recession. The world's greatest economy and the biggest economy and the most powerful economy is the American economy. They've committed huge amounts to its own rebuilding of America through their infrastructure bills. Last week, they signed off semiconductor chip bill, the chip bill they called it, where they'll start making their own semiconductor, not to be compliant and reliant on other foreign sources which might come under pressure. So governments don't want this to happen. These investment banks, who are highly, highly influential with the central bankers, they don't want it to happen. It's not in their best interests. So I talked about a win-win situation. The bank doesn't want to be in a position where it ends up not being in a position to actually exercise what it set out to do. And obviously the bank needs to make money out of this. So there's a very real reason that the bank actually underwrites these. They're not charities. They're not there to be nice. They're there to make money. And if this doesn't work for them, well, then they don't make money out of it. So long story short, recessions are generally not good. I certainly don't like recessions because it means there's a lot of bad things happening on the periphery that are affecting the core. And I always say the core is the most important thing. What happens on the outside is equally important, but it affects my core. So I need to look at that and keep an eye on it.
Yeah, I think that's spot on, Andrew. And I think the Morgan Stanley are thinking about this equally as in depth. And when they set an observation, the first observation at 12 months, I think they see the ability to see that cycle run its course to a degree. They know what the central bankers are aiming to do. They know what the politicians want. Everybody knows what needs to happen. We know that inflation has to be controlled. We know that interest rates are that key lever that can be utilized to do that. So Morgan Stanley setting it at 12 months gives that ability for it to run its course to a degree. And then once we get past that initial start of observations and we go to semi-annually, then I think we should see, hopefully, again, I have no crystal ball, but hopefully towards the end of sort of maybe the third quarter of 23 going into 24, we should start to see something that plays out whereby auto calls, we can look at our diary dates and we can say, yeah, okay, we're going to see something start to play out here and we're going to get our capital back and our coupons. But again, we've got 5 years to play with here. So very, very powerful. I think there's another question there, Jill.
There are a few. Just a response again from Willie saying, thanks, Andrew. So he also said he supposes that the recession's also probably been priced in.
They will take that as a feature.
Yeah. So then from Jan, and then Esther, I've got your question as well, but we'll start with Jan. So he said, so the semi-annual payments are not reinvested, but held back until autocall. If autocall happens after 4.5 years, you get for 4 years no return on payments. So Jan, there are no payments during the course of the term. If the product autocalls after 4.5 years, that's 5 half-yearly observations. So you would get that multiplied by the coupon value. So if the coupon value is 4%, you're going to get 4% multiplied by 5, and that is what's going to get paid out plus your capital. Does that answer your question? Okay, then from Esther. Okay, worst case scenario, you get 65% back of your investment, losing 35% of your investment. Probable best case scenario, you get around 12% of what you invested. Is that correct? No.
No.
Andrew, do you want to
do that, Andrew, or shall I? Yeah, I mean, Esther, it's...
I think I'll leave it to you because you've got this tan and you're obviously having far too much fun. You can take a question.
Yeah, so Esther, essentially, as what's it? Sorry, I just need to look at your comment there, your question. Have I understood this correctly? Worst case scenario, you get 65% back of your investment, losing 35. Probable best case scenario, you get around 12 of what you invest. Is that correct? Okay, so I would say that the situation is that if the product goes to full term, then essentially what happens is, what is the position of the worst performing index within the 3 indices? And let's say that the worst performing, let's say it is the NASDAQ, let's say it has reduced by 40% from strike date, then you will lose capital on a 1-for-1. So effectively, you will get 60% back of your 100% capital. That is the scenario. So it's all about the worst performing index if the product goes full term. So if it doesn't go full term, what that means is within the observation dates of that 5-year term note, if on one of those observation dates, the worst performing index is 100% or above, then the product will auto call and you will receive 100% of your capital and the number of semi-annual points accumulated for your return. So that hope.
Yeah, and then just to add to that, Graham, is that if at that very last observation, it runs to term, at the very last observation, say the worst performing stock has dropped by 20%, because you're over that 60, you're more than 65% of the starting price, you get your full capital back. So it's only if that worst performer drops by more than 35% is your capital affected. If it drops by less than that, you still get your full capital back. Okay. Awesome. Glad that's answered. If any other questions, otherwise what we'll do, we'll close off. We're going to have the recording available probably by tomorrow's Friday, tomorrow's afternoon or by Monday. Kim will send it all out to you guys. If anybody wants to make contact, get the ISA number, wants more information, have another chat, ask any other questions, just pop a mail through to support@Cashbox.Global. Kim, make sure you're ready for your email box, your mail. And with that, I just want to say thank you, everybody. Thanks, Graham. Thanks, Andrew. Thanks, everyone, for attending, and have a great evening.
Take care, guys.
Thank you very much. Thanks, guys.
Cheers.
Bye.
Bye-bye.
Take care. Bye.